Hello, everyone. It's good to be here. I wanted to give you my perspective as we enter 2026. 2025 was a super busy year, and I spent the first part of this year really digging into research reports from a lot of the top firms on Wall Street. So, from Goldman Sachs, BlackRock, Schwab, Lazard, T. Rowe Price, really tried to get a holistic perspective on what the outlook is for this market and the economy around the world. The main thing I want to convey to you is diversification is always important, but it's more important, I would say, this year than we've seen the last few years. So we've had a very concentrated market, concentrated in tech, concentrated in artificial intelligence companies. Now, what has happened, and this is something that I am managing in your portfolios and that you need to be aware of, even outside of the assets that I manage. The standard index funds like the S&P 500 are market cap weighted. It means that the largest stocks make up a disproportionate amount of the index. So right now, out of 500 stocks in the S&P 500, the top 10, which are mainly tech companies, make up over 40% of that index. So the first thing I want you to be aware of, if you're using strictly index funds, especially the S&P 500 index, you are no longer diversified. So diversification is going to be the theme for 2026. You cannot simply index this year. We need to be focused on being nimble, being flexible, and having additional diversification more so than what we may have had the last few years. So I'm incorporating active strategies along with the index, meaning that strategies that can be a little bit more flexible, a little bit more reactive to what's happening in the market, because there's going to be so much uncertainty this year with the deficits, with the tariffs that we're seeing. We're expecting inflation to continue to come down, and that would give the opportunity for the Federal Reserve to cut interest rates. But the outlook is uncertain around inflation because of the deficits and because of the tariffs. That inflation may start to spike up again later this year, which would have an impact on the overall market. So we want to remain flexible. Also, as far as your bond allocation is concerned, we want to make sure that we're using bonds that can adjust to what's happening in the overall economy as well. Because again, if inflation takes hold, that's going to have a pretty significant implication on the return of those bonds. So we want to make sure that we're diversified there as well. From talking to me over the years, I've introduced a category called alternatives to the portfolio. These are investments that do not correlate to the stock market, nor do they correlate to the bond market. So adding that additional diversification against this backdrop from what we're going to see most likely in 2026, I think those alternatives are extremely important. So we're going to continue to overweight or have extra exposure, additional exposure to those alternative asset classes in the portfolios. We've also seen with all these artificial intelligence companies that the returns have been really strong with those companies. But now the market is starting to scrutinize how much money they're spending to build out these data centers and really to bring this new technology to fruition. And they're looking at how much they're borrowing to get the money to be able to spend to do this full build out. And a lot of the companies are coming under pressure because of that. So again, diversification and broadening out how these portfolios are exposed is extremely important, especially in 2026. I'm also expecting that our currency, the US dollar, continues to weaken relative to some other currencies around the world. Now, that bodes well for international investments. They had a good year last year. I'm expecting international and emerging market companies to also have a strong year in 2026. So we want to make sure that we have adequate exposure there and we have the right representation for those international companies as a part of the portfolio. Now, many of you are retired, so we want to continue to have that strong income, those high quality companies that pay strong dividends, that are able to grow their dividends over time. We want to be at a premium this year. That's why the safety nets that we've always had in place, those guardrails, are so important to make sure we have adequate cash in the portfolio to pay out if you need to withdraw money or to be able to reinvest if we see a pullback. If we do see a pullback also, I'm going to look to do some roll-up conversions. Many of you have done roll-up conversions where we take money from your IRA account, convert it to a Roth account. We let that money grow, hopefully to the sky, and then pull that money out tax-free. So I'm going to be looking for opportunities this year to continue to do that. as interest rates come down, if they continue to come down, that should bode well for smaller to mid-sized companies because they tend to borrow more money. As I wrap up, a couple of things to always remember. Trying to predict the future is a fool's game, right? They don't offer an MBA in clairvoyance. So the main thing, we want to make sure that we have the guardrails in place and that we have a game plan for if the market continues to appreciate or if the market pulls back, we're going to have some dry powder to be able to get back into the market at more favorable prices. If it makes sense to do some Roth conversions, we can certainly do that. But I'm going to be reaching out to you according to our normal cadence as far as our check-ins are concerned. But if you have any questions at all, please don't hesitate to reach out to me. This is Antoine Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.